Good morning, everyone. I'm Phillippe. I'm with BitFarms, heading corporate development activities there. So I've been with the company 3 years, 4 days into halving today. Pretty excited to be here. BitFarms is a vertically integrated Bitcoin miner. We're based in 4 countries, Canada, US, and Paraguay, Argentina. We currently run 7 exahash with mostly hydropower. So that's us.
Good morning, everyone. My name is Irwin, pronounced Nisha. I'm with Block. I'm the head of product for the Bitcoin mining project at Block. Block, as you may know, is a large financial services company. We offer the Square Reader as well as the Cash App, and we've recently started investing in Bitcoin mining across the stack. I'm excited to say that we just shared this morning that we are taping out a 3 nanometer ASIC, and we will also be building a full mining system as well. So I'm excited to hear from Bitcoin miners about all the issues that they face with mining systems. Love to hear from the panelists as well, the issues that they face, so that we can sort of help to build the best mining system that we can build. So I'll hand it off to my next panelist.
Hey everybody, Riley Trettel from HUD 8 here. I am responsible for the corporate development team at HUD 8, where we do greenfield site development, M&A, and energy strategy. So HUD 8 is a public mining company. We have Bitcoin mining facilities in Alberta, Ontario, Texas, and New York. We also have traditional data centers in Ontario and British Columbia. So excited to talk to you all today about energy and the halving, and what miners can do, on the long tail of mining and the energy industry, and what, product market fit our industry has. So, thank you.
Hi, I'm Greg Beard with Stronghold Digital Mining. Stronghold is different in that we own our own power assets, own our own data centers, and mine Bitcoin. So I think the advantage of that model is that if power prices are super cheap, we can shut the power plants down and just pull power from the grid. If power prices are super expensive, we'll shut the data center down and just sell power into the grid. And then I think everywhere in between we look like the other miners. But I think given what's happening in the power markets, probably worldwide, I think that strategy will most likely be more and more emulated by other folks in the space. And we do it while we're cleaning up the environment. We actually are a carbon negative process. Our plants are in Pennsylvania, and we're reclaiming the remnants of coal mining as our source of power.
And I'm Schnier. I'm the head of investor relations at BitDigital. We're a Bitcoin miner with operations in the US, Canada, and Iceland. We're also a bit different in that we actively stake Ethereum and have a new but rather large HPC business.
Great, so let's get started. All right, so we had the halving happen, but I know that the title of this is that there's a supply squeeze, but I've been checking the mempool and I don't think you guys are very squeezed right now. So what do you think about this in the short term? You're still getting roughly what you got before the halving. How long do you think this is going to last? And do you think that, is this going to be a new normal, or is this trajectory that we've all been believing will happen, which is that ultimately over time, you're going to have profitability continue to be at the margins? Or do you think that, this is the new normal and things are going to get easier for the mining industry? So I just love to open that up and be, a little controversial to start the panel off. So I'd love to hear from anybody and everyone on the panel.
I can take a crack at it and then be corrected. So this halving isn't a surprise. The miners have been preparing for it for years. And if you looked at what's already happened since the last halving, the global exahash went from 100 to 630 between halvings. So we've already had the rewards absolutely crushed just by competition amongst ourselves. So a mere halving compared to having the rewards, they were already cut by 85%. Because Bitcoin went up 7-fold, the hash price was sort of unchanged, or it wasn't a disaster. But we're designed for efficiency. We're always upgrading our fleets. If you're in the power business, you have another lever to try to decrease your cost of power. So I think if you looked at the halving, hey, we're ready for it. Will the rewards and the transaction fees, mask what's the economic impact they're having? I doubt it. I think we're going to see, you're going to have to continue to upgrade fleet or continue to find lower cost of power. Like if I had a fear for the industry, the industry was really built during a time when there's little competition for power. So we've had no power demand increase for 15 years in the United States. And I know it's a global market, but focus on the US. We're now seeing demand for power mostly related to AI of about 100 gigawatts over the next, call it 5 to 6 years. And Bitcoin mining might grow 10 gigawatts. So if you look at folks that are on power purchase agreements, if they're thinking they're going to get the same deal they got last time, they're not. So, and if you think you're going to have no competition for like the growth for the new data center, you're going to have it, and you're going to be competing against a guy who is much bigger, like the biggest companies in the world, and they're going to win out on the development of a lot of new sites. And so I think if there's a fear for growth in the space, we'll see the exahash continue to grow, which is like just creates ever more urgency for either securing low cost of power or buying better machines.
Maybe I can just concur with what Greg's saying. The run for low-cost power is key. I personally think that the Bitcoin halving is a tremendous opportunity to bring discipline into this industry, and that maybe we are 4 days into halving experiencing some sort of cushion with the transaction fees, still making our business very profitable today, as we might not have expected a few weeks back. If it's not the network, the reduction in the Bitcoin subsidy and the block reward is going to help us compete, that will compete us out, it's going to be ourselves. Network hash rate growing exponentially since last year. As Greg mentioned, now sitting like somewhere between 630, 650 exahash is crazy. The point is investing in sustainable sources of power is key for Bitcoin miners. We're now competing against the big hyperscaler data center, other source of load, and ultimately the rigs that may make our business profitable today, the new generation miners that have very efficient chips on it, might give us an edge maybe for a year and a half, but ultimately it's always going to come back to low cost power, sustainable source of power. And these sites that have access to that in the long run will survive and probably have a bright future in a more disciplined and competitive mining industry.
Yeah, I mean, just echoing what the other people said, I agree with everything. I think that in the short term, while it has been nice to see, fees juicing, I think that maybe 6 months ago, people thought that we were going to have a downwards difficulty adjustment right after the halving. You could kind of see that in, Luxor's forward hash price markets. You could see that there was a steep tick up right after the halving that was like higher than the option premium you could get on Bitcoin. But recently you see that the forward hash price curve looks a lot flatter. So I think everyone in the mining industry, at least over the past 6 months, was kind of coming to terms that the hash rate, the network hash rate, is going to continue to run. And so I just want to dig a little deeper on what folks have been saying about zero cost power. I think 2022, the end of 2022, is a really interesting case study for the mining industry. We had hash price at about 5.9 cents. And then natural gas ran up to about $8 at Henry Hub in Texas. And so that squeeze in the power marketing business, combined with the squeeze of Bitcoin being at 16,000, it put a lot of miners out of business. Now, there was a lot of debt that caused that to blow up, but there weren't a lot of people who were mining profitably in West Texas at that time. And I think that, while efficiency in Texas, efficiency of our fleets has gotten better, it's not going to be enough to just, have a fuel-based power purchase agreement or be connected directly to the system. Because if gas does run, you're not properly hedged, then you can get squeezed. And so the key is finding areas that are particularly distressed. And, Bitcoin miners need to get involved in the power markets. So right now, there are only, two real players in power marketing. You have the generators and you have transmission. Traditionally, generators were the fast ones. Transmission was slow. And so generators would go into pockets of load and serve those high pricing conditions. And transmission would eventually catch up a decade later when they had approval and a fixed rate of return and everything could be built. But now, these industrial scale Bitcoin mines are a new asset class in power marketing, in that we can go to pockets of generation and essentially we're competing with transmission. Our industry is already 3 times faster than the fastest generators, and we're 30 times faster than the fastest, transmission operators. And so our ability to go into these locations is going to be key and fix, local system congestion issues. That's how, miners are going to be able to manage through hash rate over 1,000 exahash and continue to grow very soon. So this epoch is going to be, highlighted by the miners who, became an energy asset class participant or a new type of energy asset. It's going to be less about, announcing more efficient machines and, going and raising money and plugging those machines in. And it's going to be much more about, what access to power do you have and what specific problem are you fixing? Because if you're not going to a location and solving a problem and essentially extracting value for solving that, it's going to be hard to, to meet the bid that AI is going to put out, that just general load growth is going to put out. So, that's what I think is going to mark these next 4 years. Maybe we'll have some times where Bitcoin price will boost and we'll have good hash prices, but I think we can see, $40 break evens, even with the most efficient machines in the near future. So,
Okay. Those were all really great responses. So I've heard people say efficiency already a lot on this panel and sustainability on this panel. And I really want to get into that a little bit more and understand a bit more how that relates to the halving, the supply squeeze in terms of the block subsidy, and what each of your companies are doing in that regard. So I would just love to hear first from anyone in terms of what does sustainability mean within the context of the halving and Bitcoin mining?
I personally think the halving is counterproductive for sustainability, just because it squeezes industry-wide margins, and capital markets aren't given enough credit to companies that are sustainable. They'd rather see a lower break even, and that's far more pertinent post-halving. So I think the incentive to gravitate towards carbon-free energy has been diminished, and I think that's part of where we are in the investment cycle. So I think ESG in particular is kind of a bull market phenomena, and right now it's like if 2 companies press release 100 megawatt installation, one's 100% carbon free at 4 cents and the other is using coal at 2 cents, I think the company that announced the coal installation gets a lot more credit. And I think that's sort of not the healthiest dynamic for driving the industry forward.
So actually, I have notes because I want to say something that's incorrect. So we were not peppered with questions in advance. So this is just, I carry these around just in case I'm asked. As we make the grid more renewable nationwide, we're replacing baseload fossil fuel plants mostly with intermittent sources of power like solar and wind. There's a misnomer that like solar is quote on par with fossil fuel in terms of cost for the consumer. And maybe if the sun is shining and it's midday in the summertime, you could say, hey, it's a cheap source of power. But the quote capacity factor of a solar facility versus a baseload fossil fuel plant is a fraction. So just the math shows, and I will get to why this relates to Bitcoin in a second. If you want to replace a 100 megawatt fossil fuel plant with a solar facility, you need to build a 556 megawatt solar farm, and you need a coupled to a battery that's equivalent to 15,000 Tesla batteries. The cost of that facility all in would be $1.7 billion with today's costs. So as a society, we should say, don't do that. But hey, the die has been cast. We are doing it. We're going to build all this renewable stuff. The way to prevent the consumers from having an even higher cost of power is to, instead of installing those 15,000 Tesla batteries to make the grid function, since we need power around the clock, is to use Bitcoin mines as the battery. So as an industry, we're going to grow, 5 to 10 gigawatts over the next 10 years. We're going to end up adding to our renewable sources of energy, unless we find a better solution, which I will tell you as an energy investor, we've been working on better batteries for 30 years, and it's not going to happen overnight. A great interim step is to replace that battery with a Bitcoin mine that can respond to the grid market forces, market pricing, faster than a battery can respond. And so I think that's like, how do you, to roll this back to how does this work with the halving? I'm not sure if we're looking for lower power costs, which I think with the halving, we all need them. I'm hopeful that the grid operators, which I think are beginning to understand utility of mining in the context of renewable energy, and can understand that we'll be part of the solution to let us participate in demand response and other systems that will incentivize us to exist, kind of to save the coming destruction of the grid if we don't do it. Because you can't make a state 50 or 70% renewable without having a reckless amount of batteries, unless you're willing to live in the dark half the time.
So I just wanted to add a couple of points. I definitely agree with what Greg was saying about the role of Bitcoin mining in grids that have a significant amount of renewable energy on the grid, where Bitcoin mining can play this flexible load role. That's pretty much unprecedented in energy grids. There's never been an at-scale flexible load like Bitcoin mining in history. And so it provides a great opportunity to soak up excess power at times when there's excess generation and energy prices are very low. And I think that may be an increasing trend as in the post-halving era, when profitability is getting squeezed, people will start to sort of increasingly search for these super low power opportunities. And I think there's more to that as well. If we look forward, it's maybe not something for today, but with the halving and this increasing pressure on miner profitability, looking at things like stranded power, flare gas mining, heat reuse, I think there will be an increasing push into these kind of some more distributed mining opportunities, because the power cost is so low and you can profitably mine. And that will be good for sustainability, because stranded flare gas mining is a positive for the environment. Heat reuse would be also a positive for the environment. And so I think there's exciting opportunities long term. And look forward to seeing how those play out.
Yeah, I think that it's important to understand, how these large-scale renewable energy assets are actually invested in by our society. The question, you touched on ESG. From a governance perspective, our society has decided that renewable energy or carbon-free energy should receive a tax credit. So whether an investment tax credit that buys down the capex of the facility, or a production tax credit for each unit of energy that the facility produces. And so, the reason that there's so much renewable build out happening, and I'll take ERCOT as an example, is, these facilities, and Greg illustrated it well, how big you have to build these to serve load. These facilities in a vacuum only generate an 8% return. So in a current interest rate environment, it's going to be hard to take all this operational development risk for companies for an 8% return. And so what the investment tax credit does is it essentially takes advantage of, 10 companies in the United States that generate enough net income where they're able to throw money at things to get tax credits to buy that down. And so when a bank comes in and does tax equity financing, takes the tax credits, takes the depreciation off the asset. The bank is targeting an 8% return. By buying down the facility by 30%, the person who built the facility, the developer, is getting about a 15% return. This is for merchant solar, merchant wind. Now, what's happened in ERCOT is that there was an extreme build out of wind infrastructure that happened from about 2005 until like recently. There are not many wind farms being built in ERCOT right now. The resource is super strong, but there's a lot of congestion. Transmission hasn't caught up, and the projects don't generate good enough returns for the developers. They're hard to operate. And the banks, they'll take the tax credits, but they don't want to take the operational risk, the basis risk on the return of the project. Can the project actually deliver energy? So when we talk about the E and the S, assuming that we're not going to build any nuclear baseload, the only way for us to get to total carbon free, which we've decided that taxpayers are going to finance these projects and make them return. So like these are being built because we are paying for them. So if we're going down that road, in order to actually get to a carbon-free grid, we need to have projects that generate returns. And so you were only 10% of the way in ERCOT, which is the most renewable penetration of any system. And wind is already dying down. Solar boom is happening right now, but in a few years, that boom will probably die as well as congestion issues occur. So to the extent that a load can come in and soak up generation, it's going to be key to ever achieving the E and S without nuclear to get to like a carbon-free electricity grid. And so if you have to build 10 times more projects, you're going to need a buyer for all that power. And so essentially, we need to build the system so that in the ramp, when the wind isn't blowing very strong and the sun is starting to set, that the renewable projects are still generating enough to meet all the critical load. And so all the Bitcoin miners will be shutting down. Essentially what that looks like in 20 years, if that ever comes about, would be, maybe 100 gigawatts of critical load in ERCOT and thousands of Bitcoin mining or flexible loads to soak up all that power and make sure those projects return. So it's very sizable to think about it like that. Like to tie it back to the halving, can the Bitcoin network support that kind of build out? I think if Bitcoin mining can't support that, from a revenue perspective, and we can't provide that flexible load service, like there's no way we're going to be able to achieve, a net zero solar and wind only with battery. There's just going to be too much stranded generation, and the projects already aren't returning. So from that perspective, we have a long way to go. And I think the Bitcoin network is going to take a very important role in getting us there.
If I may just add on what the other folks on the panel just say, obviously when we talk about sustainability, we drift automatically into ESG and renewables. But tying it back to your question, Margot, about halving and how this cataclysmic event in the Bitcoin mining industry gets us to be more disciplined, there's a fair case also for baseload that provides sustainable access to power. And by sustainable here, I mean having a long-term view of being able to use that power, these electrons, to be converted into Bitcoin digital currency. And here I'm referring to, nuclear is a great source of power for the future, but there's also hydropower. And at BitFarms, we've been fortunate to hook our destiny to stranded hydropower in various jurisdictions. We currently hash 170 megawatts of hydropower in Canada, about 20 megawatts here in the US. That's hooked up to the largest generator in the US. And we're currently building 170 megawatts at the second largest hydro dam in the world, which is located on the border between Brazil and Paraguay. What's interesting about these facts is we get very low cost power that can be directed to our activity, but also we get, to my knowledge, one of the only downward shaped cost curve looking forward. And this is not necessarily due to the fact that it is eco-friendly or ESG-friendly. The purpose there is really that the power has low inflationary exposure. Every single additional drop of water going through the turbine has marginal cost of zero. So basically in Paraguay, we're actually looking to see power costs go down in the future for a huge amount of energy. This sustainable nature of that load helps us to raise the funds and the capital that are required to build that Bitcoin infrastructure and take it to the future. So back to your question, I think the halving events that make this industry more competitive every 4 years by nature of the design automatically commends us to think about sustainable power, not only in terms of ESG, but how we can see in the future we'll still be hashing on those sources of power.
We've talked a lot about renewable energy. I've heard people mention demand response. This grid reliability has become a really important topic within the industry itself, especially in ERCOT, but also in other parts of the country. Bitcoin miners are doing this type of curtailment. So to me, these are all the conversations that started happening around within the last epoch on a bigger scale. But we know that over time, right, the subsidy is going to be cut in half. And in the early 2030s, the subsidy is going to go below 1 Bitcoin. So I would like to end the panel hearing from each of you about what do you think the discussions will be in terms of efficiency and in terms of integration of Bitcoin mining within the energy sector itself. Because if it is true that you're going to have to get more efficient operationally, and you're going to be pushed towards the cheapest electricity, where does that leave you when the subsidy is below 1 Bitcoin? What are you going to have to do to be competitive in that environment?
I think you answered the question in your question. Unless you have very, very cheap
I guess I'm asking, like, what is your vision of what that might look like?
No, I think you're going to see more vertical integration between power companies and Bitcoin miners. That's the only way. Also, this system is designed to be efficient, and then if it becomes less economic to mine Bitcoin, fewer of us will do it, and we'll be sharing the rewards among fewer miners, and that in itself will make it worthwhile. So it's a competition. So the reward's going to be halved and halved again and halved again, and ultimately it's a little bit of a futile exercise to constantly upgrade your rigs because they only have a life of a few years. Like our focus has been to constantly try to lower our cost of power because that's a sustainable way to grow in this business. Just spending capital. Like if I were to criticize my own industry, many of us are very proud about how fast we grow, but we're probably destroying capital because we don't know what the return on all that investment will be. If you can make an investment in cheap power, and you will be a survivor. And so that's where I think, hey, where is the industry heading? I think, hey, we're going to have at some point it'll flip from, hey, just grow more and more exahash to, hey, who can make the most margin? That ought to be the next question for the industry. The way to make the most margin is to have the lowest cost of power. And that's true today, but that'll be even more true in the future.
On the most basic level, we just all have to sit back and hope that Bitcoin appreciates by 20% a year to make that work, and that transaction fees finally, or maybe sustain where they are today, which is unlikely, but make up a larger and larger amount of the block reward. I mean, at the end of the day, it's a race to whoever can get 0-cent energy in 10 years, and that probably won't be a public company. That'll probably be a sovereign nation. It'll probably be Saudi Arabia. So as a public miner, I think it's just imperative to have at least some other revenue source that's not correlated with Bitcoin. So during those times where you are sub break even, you're able to keep the lights on. You could cover your cash G&A. You have different resources at your disposal such that you don't have to either deplete your balance sheet or raise external funds at super dilutive prices or debt at, right now that you're raising ASIC-backed debt, you're getting somewhere in the mid-30s. At that point in 10 years, depending on where interest rates are, it would be completely prohibitive. So, and I think those are sort of the two tracks.
Yeah, I agree with what these guys have said. I think that from a revenue perspective, as the block reward tends to zero, there needs to be demand for block space. And something that all miners have learned very acutely about the energy industry is that supply and demand happens on millisecond timescales. And so your ability to react, you can get directly rewarded. I think that the Bitcoin network is, not necessarily built or designed from the beginning to be that reactive. I think the only supply and demand based reactive system that Bitcoin as a system has is that if hash rate falls off and block times extend and people still want to push transactions through, then you're going to see transaction fees increase. And that's a decent, incentive mechanism, but it can't operate any faster than on like a 2 or 3 day timescale. And so I think, coming back to what everyone has said about managing costs, like from the Hut 8 perspective, we just want to be able to manage through energy volatility and become, a participant in power marketing, because through trading, through hedging, and through fixing revenue, fixing costs, you can make these facilities financeable and you can make this industry more mature. I think if you make mining more mature, you make mining a key participant on the grid, it should drive demand for the usage of Bitcoin on the main chain. And so if you have financeable assets that are considered investment grade by the biggest banks in the same, light as solar or wind, and you have Bitcoin mines that are providing returns for those, you may have a lot of block space demand for, real use cases that can be built. I think we're seeing a lot of interesting stuff come out. But when you actually leverage the power, the fact that you can't change Bitcoin, it is immutable. And so when you use that to your advantage, and when more traditional counterparties use that to their advantage, we may see that demand for block space that we've been looking for.
Just a couple final comments from my side. So I definitely agree that hopefully the Bitcoin price will continue to appreciate, and that will somewhat compensate for the declining block reward. Hopefully, fees will play a greater role, as everybody kind of hopes, I think, to make mining sustainable. At the same time, I do agree with the comments about vertical integration with the power source. I think that could take some interesting forms in the future. Where there'll be a greater push into more distributed hash rate and distributed mining. Sort of picking up on the point around heat reuse, there's a lot of very interesting applications of mining with heat reuse, and where you essentially have a zero cost of energy for mining because the heat is already being purchased. And so I think that we may see a push into some of these areas over time to try to exploit some of that very low cost energy. Which would, I think, really change the picture for Bitcoin mining. So that's something that I'm excited to monitor.
Yeah, and on my side, also agreeing with what was already said, I think the ever increasing competitiveness of the Bitcoin network pushes the technology to evolve. What we're probably going to see when Bitcoin reward is under 150 Bitcoin a day, 144 or whatever is, that the activity will remain profitable for large base loads that are hooked up to really, really sustainable and low cost power. And also those that are even more creative in integrating with the grid, using pockets of energy or curtailment strategies that really benefit more than just the grid. And that finally, these strategies will be expressed to much fewer vehicles than the 25 plus so public companies that we currently have in the market. So the run to efficiency ultimately should also overtake the capital raising strategy. and probably lead to an epoch of consolidation in our industry as well. So looking forward to that next epoch.
Awesome. Well, we're out of time, but I would just love for everyone in the audience to give our panelists a round of applause. Thank you for attending, and thank you to our panelists for participating in the discussion. Have a really great day.